Hello, everybody. I hope everybody's well. Do a little look at the market here, a real life or real time, I should say, technical analysis lesson. And remember, the S&P 500 is the sum of its parts. There's 500 stocks, which is hence where the name comes from, and there is 11 sectors. So every one of those sectors, or every one of those stocks, is one of those sectors. So I see some interesting or some informative things happening in the industrial sector. So let's just take a quick look at this. Alrighty, now, what do we see here? Well, we have really well-defined resistance around 103.50. We have really well-defined support around 97. Resistance is a large group of investors who are looking to sell their shares at or around the same price. In this case, it's 103.50. If the market's moving higher, there's not enough supply or sell orders to fill all of the demand or buy orders. So what happens? The buyers are forced to pay higher prices. They have to pay a premium, and this forces it into an uptrend. Now, when we get to resistance, the tide turns. All of a sudden, there is enough supply to fill all demand. As a matter of fact, there's even more supply than there is demand. But what happens? Well, the investors who want to sell start to realize that there are other sellers around. That's why the price is not going any higher. So some of them start to get nervous that they're going to miss out because if someone else is willing to sell at a lower price, that's who the buyers are going to go to. So these investors, as they get more anxious that they're not going to be able to sell, they start to reduce their prices. And you get this snowball effect. Coming off a resistance level is a very common thing, and it's a tradable thing. And 98% of the time, what they tell you on the news is not right about why something is moving. It's generally because there's some kind of technical thing going on. It's not because of what's going on in Ukraine or I don't know, COVID this or Jerome Powell that. It's psychological. You have to look at these charts through the context of what do they tell us about human psychology or investor psychology, and what do they tell us about supply and demand. Now, on the opposite side, when the market's going lower, there's not enough demand or buy orders to absorb all of the supply or sell orders. So the sellers are forced to offer their shares out at a discount to get the buyers to come off the sidelines. When we get to a support level, well, the tide turns. Now there's enough demand. All the sell orders can be taken in. Sellers can sell whatever they want. Now we get the opposite. Some of the investors who want to buy start to think, "Oh, gee, there must be other buyers around. That's why the price is not going any lower." So they start to get worried they're going to miss out, and they start to outbid each other. So just like we had sellers undercutting each other coming off a resistance causes a sell-off, buyers trying to outbid each other causes a bounce off of support. That's it. It's just investment psychology. Don't be overly concerned with all the fundamentals or whatever they're saying on CNBC or Fox Business News or whatever. I would suggest you just shut those things off, man. Put on something that's enjoyable to watch, like some show about nature or Walker Texas Ranger, or that's what I usually do. I usually have on a Nature Channel or History Channel. All right, but anyway, so this is resistance and support. Now, another interesting thing here. Remember, we have to look at these charts through the context of supply and demand and human psychology. This is your classic descending triangle pattern, which is starting to form. Now, what is going on here? Well, we got the buyers are hanging out down at 97. They're okay with just waiting for the sellers to come to them. They hold their ground or they hold their line and they hang at 97, and that's kind of it. They say to themselves, well, if I buy it, I buy it. If I don't buy it and I miss it, not a big deal. I'll find something else. But as time is going by, this descending line tells us something. These markets go in peaks and valleys. And when you have a peak that forms at a lower price than the prior peak, like here, this is a lower peak than this is a lower peak than that. What is this telling us? That as time is passing here from April into May, the sellers are becoming more aggressive. They're willing to accept lower prices. So you have buyers who are just chill and kind of complacent, and you have sellers who are becoming more aggressive. A lot of times when we get to a support level and there's this succession of lower highs leading into it, we tend to break the support. That's a good way of knowing if support is going to break or not. I mean, of course, it's not guaranteed, just like anything. in life other than death and taxes, but it stacks the odds in your favor. Regardless of whatever market it is, whether it's stocks or cryptos or commodities, when you have complacent buyers and aggressive sellers, it sets the stage for a move lower. Just supply and demand. The supply side is more aggressive than demand side. Remember, every time we look at a chart, you have to ask yourself, what does this tell us about the supply and demand picture? When things are going up, there's not enough supply. When things are going down, there's not enough demand. That changes when we get to support or resistance. The descending triangle is as time is passing, sellers are getting more aggressive, and the buyers are just chilling out. Anytime you get aggressive sellers and chilled out buyers, well, there's a good chance the price continues to move lower. Okay, everybody, thank you so much, and I hope to see you soon.